Now, we said that the balance sheet accounts are permanent. In other words, the balances of them remain unless you get rid of them. So, for example, cash, you have a certain amount of money in the cash, and if you want to reduce it, you spend the money. And if you want more, then you deposit more money. And that's how you know cash is. Temporary accounts are accounts on the income statement, revenues and expenses. Revenues and expenses are not like this because what happens is they accumulate over a period of time. Sales, for example, would start at the beginning of the year with zero, and then every time you make a sale, it goes up until December 31st, towards the stroke of midnight. You can see what total sales was for the year. What you need is you need a way to zero that out. So it's kind of like the trip odometer on your car. You accumulate the miles and you press the button and it goes back to zero. Same thing for sales. What you want to do is you want to accumulate sales over the whole year. I should do my hands up here because you can't see. Accumulate sales over the entire year. And then you hit the button and zero it out at the stroke of midnight. So the way we do this in accounting is by what we call closing. This is Module 2, Learning Objective 9. So with a template, what you would do is you would simply bring everything down to zero. T account's the same thing. You would simply bring all your revenues and expenses down to zero. In journal entries, this is how companies do it, is they also bring all the revenues and expenses down to zero and they deposit the difference into retained earnings. So for example, for sales, normally sales has a credit balance. You would debit sales and the credit would go to retained earnings. In fact, if you took intermediate accounting, you saw they did this to income summary, a P&L summary, something like that. So they kind of took an intermediate step. And here I'm just putting it straight to retained earnings. Same thing with expenses. They're closing each expense item by crediting it. Normally they have debit balances. Crediting your expenses brings them down to zero. And they're putting them into retained earnings again. So all of these balances are getting accumulated in retained earnings. Then finally, you would close out your dividends. Dividends normally has a debit balance. You credit it, and that also goes to retained earnings. So what happens here is the revenues get credited to retained earnings. They don't show you the T account here. The expenses get debited to retained earnings, and dividends gets debited to retained earnings. And that has the same effect as beginning retained earnings plus net income minus dividends equals ending retained earnings. Did I say that right? Beginning retained earnings plus net income minus dividends equals ending retained earnings.